Investment term of the day. Internal rate of return, IRR. The internal rate of return is a metric used in capital budgeting to estimate the profitability of potential investments. The internal rate of return is a discount rate that makes the net present value of cash flows from a particular project equal to zero. IRR calculations rely on the same formula as NPV. IRR is sometimes referred to as economic rate of return or discounted cash flow rate of return. The use of internal refers to the omission of external factors such as the cost of capital or inflation from the calculation. Generally speaking, the higher a project's internal rate of return, the more desirable it is to undertake. IRR is uniform for investments of varying types and, as such, IRR can be used to rank multiple prospective projects on a relatively even basis. Let's assume the cost of investments are equal among the various projects. The project with the highest IRR would probably be considered the best and be undertaken first. A popular use of IRR is to compare the profitability of establishing new operations with expanding existing ones. For example, an energy company may use IRR to decide whether to open a new power plant or to renovate and expand a previously existing one. While both projects are likely to add value to the company, it is likely that the IRR will determine that one will be a more logical decision compared to the other. IRR is also useful for corporations in evaluating stock buybacks programs. Clearly, if a company allocates a substantial amount to a stock buyback, the analysis must show that the company's own stock is a better investment or has a higher IRR than any other use of the funds for other capital projects. In theory, any project where the IRR is greater than its cost of capital is a profitable one. Thus, it is in a company's interest to undertake such projects. Any projects with an IRR that exceeds the required rate of return, or RRR, will likely be deemed a profitable one. Although companies will not necessarily pursue a project on the basis alone, rather, they will likely pursue projects with the highest difference between the IRR and RRR. The internal rate of return can also be compared against prevailing rates of return in the securities market. In practice, IRR is calculated by trial and error since there is no analytical way to compute when NPV is equal to zero. Computers or software like Excel can do this trial and error procedure extremely quickly. While there are issues with IRR, it can be a good basis for investments as long as the problems referenced earlier in the article are avoided. And that was your investment term for the day.